Chapter 9 covers fixed assets and intangible assets. First, we're going to describe, classify, and account for the cost of fixed assets. Fixed assets are long-term or relatively permanent assets such as equipment, machinery, buildings, and land. They may also be called plant and equipment, or it could be buildings, plant, and equipment, or machinery, plant, and equipment. Basically, fixed assets are things that you're going to keep around for a long time and have a long, useful life. Fixed assets have the following characteristics. First of all, they're tangible, so they're physical, you could pick them up, you can touch them. Second of all, they are owned and used by the company in its normal operations, something that you use daily, something that you need for the company to run. Also, they are not offered for sale as part of normal operations. So someone's not just going to walk in someday and be like, hey, I want to buy that. That's not a fixed asset then. If it's something that's for sale, it's not a fixed asset. So to classify costs, first, step one, you look at, is the purchased item long-lived? Is it going to be something that we have for a long time or a short time? If it's not long-lived, then it's an expense. If it is long-lived, we look, is the asset used in normal operations? If yes, it's a fixed asset. We buy a new piece of equipment to manufacture a part. It is long-lived. We're going to have that piece of equipment for a long time. We use it to manufacture parts because that's what we do. It's a fixed asset. If we have it for a long time but it's not used in normal operations, it would be considered an investment. So some costs that are associated with acquiring fixed assets, these costs have to be included in the cost of the asset, because without doing these, we would not have it. So if we have a building, we might have things like architects and engineers' fees. Without paying the architect or the engineer, we have no building, so it's part of the cost of the building. Insurance costs occur during construction. Without those, we would not have the building. If you look down, all of these items we had to pay for in order to have the building, so they are part of the cost of acquiring that fixed asset. Another example is for machinery and equipment. Sales tax. Without paying sales tax, we don't get the machinery. Freight, delivery. We have to have it delivered to us, maybe installed. All of these items have to be done or paid for in order to have that machinery and equipment and use it. Therefore, those are part of the costs of that asset. Land. The purchase price of the land and sales taxes, we have to pay those. Permits from the government agencies. We have to have certain permits in order to zone it for commercial purposes. Title fees. They have the title to own the land. Surveying fees. We have to have somebody survey it to see where the property line is. All of these items are required in order for us to have the land and make it usable. Therefore, it is part of acquiring that fixed asset. Land improvements are also part of the cost. We need trees and shrubs, fences, lighting, parking lots. Those are all part of making that land useful to us. Therefore, they are part of the costs of acquiring that land. Costs not included when we acquire fixed assets are things like vandalism. It didn't have to happen for us to get that. If it was vandalized, it's not included in the cost of that asset. Mistakes in installation. We pay somebody to install it wrong. We have to pay more to have it installed right. Not included. Theft. If we don't have something insured, somebody steals it, it's not part of that cost of that fixed asset. Damage during unpacking and installing. Not required to have that asset, so it's not included. Fines for not obtaining proper permits from government agencies. Again, not a standard part of that equipment to have it and make it run, make it useful, so it's not included. Those would all be expenses. We'd write them off to different expense accounts. Capital and revenue expenditures are two different things. Revenue expenditures is money that brings in that expenditures that benefit only the current period. So they benefit only the current period, so they affect only the revenue for that period, that short-term income. Capital expenditures are expenditures that improve or extend the life of an asset, so something more long-term. Revenue expenditures are short-term gains. Capital expenditures are over the long run. So if we take a look at revenue expenditures, things like normal and ordinary repairs and maintenance. It's short-term to get it running, to keep it going short-term. Capital expenditures, we add on to something, we improve it, we have extraordinary repairs to maybe completely reconfigure it. Those long-term, bigger, involved things are capital expenditures. Now let's take a look at some journal entries. First, we have ordinary maintenance and repairs. On April 9th, the firm paid $300 for a tune-up of a delivery truck. So this is a repair and maintenance expense. You would know to use that by looking at the chart of accounts, and we paid cash for it. This is a revenue expenditure or a capital expenditure. What do you think? Remember, revenue expenditures are shorter term, normal, ordinary repairs and maintenance. Capital expenditures are big ones, additions, improvements, overhauls. If we pay for a tune-up, is that regular or extraordinary? Tune-ups are regular. This is a revenue expenditure. Another example. On May 4th, a $5,500 hydraulic lift was installed on the delivery truck to allow for easier and quicker loading of heavy cargo. So we are going to go ahead and debit delivery truck because we're actually adding to the value of the delivery truck. The delivery truck has a major improvement. It's more valuable. We are also going to pay cash, so we credit cash. Is this a capital or a revenue expenditure? Capital expenditures are ones that are additions, improvements, or extraordinary repairs. Revenue expenditures are normal, ordinary repairs. Is adding a hydraulic lift normal, or is it something extraordinary? It's extraordinary. It's a capital expenditure. Capital expenditures are going to be accounted or attributed to the asset they belong with. If we look at our previous entry, it was a revenue expenditure, so there's an expense. Revenue expenditures are tied to expenses. Capital expenditures are tied to assets. Another example, extraordinary repairs. The engine of a forklift that is near the end of its useful life is overhauled at a cost of $4,500, which extends its useful life. Work on the forklift was completed October 14th. Is this going to be a big expenditure, a capital expenditure to addition, improvement, or extraordinary repair, or a revenue expenditure, a normal everyday maintenance or repair? Well, let's take a look. We are going to debit accumulated depreciation for $4,500 because we've added this value to the asset. So the depreciation is going to go down because there's more value to it. We have to add that back in so we can depreciate that additional value. We then credit cash. This is a capital expenditure. It's a big extraordinary repair. It's debited to accumulated depreciation because we're going to eventually depreciate the value of that forklift. That forklift was reinvigorated, if you will. So here is another good graphic about costs and deciding with capital or revenue expenditures. First, we look at the cost and we decide, is it going to benefit only the current period or this and future periods? Current period is a revenue expenditure. This in future periods is a capital expenditure. Okay, let's look at the revenue expenditure route. Revenue expenditure is it ordinary repairs and maintenance. Then we debit repairs and maintenance expense. We look at capital expenditures. Is it improving the asset? Then does it add service and value to that asset? We are going to debit that fixed asset. If it's an extraordinary repair, an overhaul, like our last journal entry, it's extending the useful life, then we debit accumulated depreciation. And we're going to revise the depreciation for this in future periods. We'll have to readjust to depreciate it. Because an extraordinary repair makes the useful life longer, so we have a longer time to do depreciation. If it's an improvement, like the forklift on the truck, it's going to add service to it. It adds value to that asset itself. All right, let's go ahead and take a look at example. On June 18th, GTS Company paid $1,200 to upgrade a hydraulic lift and $45 for an oil change for one of its delivery trucks. We're going to journalize the entry for the hydraulic lift and for the oil change. Pause, attempt the entries. Hopefully your entries look like this. The delivery truck is debited for the upgrade to the hydraulic lift because it adds value and service to the delivery truck. The delivery truck has now become more useful. It can do more things. For the hydraulic lift, for the oil change, it's a routine repair and maintenance, so it's an expense. It's not a long-term solution. A capital lease is accounted for as if the lessee has in fact purchased the asset. A lease is basically borrowing something. You haven't purchased it, but you're borrowing it. So a capital lease, it's like you have purchased it in the fact you're going to keep it for a long time. You then amortize that over the life of the capital lease. Amortizing is basically like depreciation. We call it different because we're borrowing instead of buying. It's a lease instead of a purchase. Leasing fixed assets. A lease that is not classified as a capital lease is called an operating lease. An operating lease is like an expense. That concludes your notes for today.